So welcome back, everybody. We have with us CA Bhavin Kapadia, who will be dealing with CARO. And for a quick introduction, I request CA Vivek Shukla to give him a formal introduction.
Thank you, Kanviya Madam. Bhavin Bhai is a qualified chartered accountant with over 19 years of experience in the field of audit and assurance. His focus area has been on statutory audit. He has supported in peer review and quality review of the firms. An avid reader and a passionate writer in the editor of his firm bulletin. He has contributed on various articles on corporate social responsibility under the Companies Act, which got published in BCS Journal. And he has also co-authored on various other articles on fraud reporting, standards on auditing and UD. He is also a prominent speaker at WRC and other study circles. And I would like to introduce Bhavin Bhai to carry on with this. Thank you.
Thank you, Vivek. I request past conveners CA Jayesha and Harsh Bhai, please come for the token of protection.
Shall we begin?
Before you start, just I want to give friends, within a month, you'll be seeing a DPDP Act coming very soon, the Digital Personal Data Protection Act. There are three concepts, sir. I recommend you if you can cover basis hygiene measures for under this Companies Act also. There's only one more day for us to get the mic, so I thought let me take this to the latest study, something that's important, showing up your here. So there are three concepts: data fiduciary, data principal, and data processor. You in individual capacity are data principal because our data create kar rahe hai, and then you are data fiduciary also because our data grow. If under this act, if there is any breach of data by data principal, the penalty is INR 10,000. But if there is a breach by data fiduciary, the penalty is 250 crores. So therefore, and data processor in our background means maybe like a tax softwares, Guru or whatever that GES or a computer tax or whatever it says. So now therefore, under the Companies Act now, because this act is already notified, it's passed by the president, it is just going to be notified in a month more. Of course, there is a book also that we are launching, but very important, please understand, we have to now take measures in ensuring that data that is collected will be sent back to them. But there is a provision that data can be taken back. There is also provision that you say them that what purpose are you using this data. So your engagement address will have to be now absolutely in a sense. Vijay madam, if you were to, sir, अपना जो Companies Act में engagement. If I were to ask you now, if I were to ask you, you cannot, your चुप्पी का मतलब हाँ नहीं बोल सकते. You have to take in absolute written terms, yes, from a client. I think that is what is important now. So please make sure that under this we also, and please use CAPT. It has all the guidance note, everything that you want, all the audit checklists, all the audit procedures are absolutely present. Make the most of it during this time. I think what the earlier speaker mentioned, what I'm sure under Companies Act we are covering, this is one of the most important updates. Somewhere you'll have to figure in that there is no liability coming under as a data fiduciary on this. With these words, thank you very much. Have a great learning session. Thank you, Kanina, and thank you, sir. Over to you.
Good morning, all of you. I think the first session was energetic in terms of the insights on how to audit the companies. I think the challenges are there, but we as a seniors has to guide our team members where in which case they need to have more audit procedures and in which case they can do on sampling basis. So I think whatever theme which we have of the study circle, JB Nagar, where there is a smile is mentioned, and one point which is this improve. One of the point is improve, where we gain from this knowledgeable session, but we need to also download this to our team members. So please make it a point that next week, whenever there is a time slot, please communicate, share some time slot, 30 minutes, and on the auditing aspect as well as the CARO, please share some insight to them so that we collectively ensure that the qualitative aspects of the audits are met, and it is a win-win scenario both for our audit team and as a fraternity. Prashant did mention twice and thrice about the planning aspects. So based on that, I recollect one which I heard some time back, that if we fail to plan, then we have planned to fail. So this is something which is very important, and considering today is the 1st September and we have now only 29 days to complete our commitments for 30th September. So I'm sure there will be largest unit which will be generated for standalone console tax audits. So I think we all have limited time, and this is the right time where both these topics are being taken care on the auditing as well as the audit reports. So, CARO is not something which is new. It is there, 143, section 143 is there, friends. It was there in 1956 as well, and even in 2013. What has changed is more elaborative, where they are asking the auditors to comment on each and every aspects. So to term this or coin this CARO in a different way would be, it is a comprehensive accountability of the points. If you look at the entire gamut of those clauses, the entire balance sheet, large areas are getting covered, be it equity, borrowings, inventory, fixed assets, loans, advances, something on the compliances, RBI front, CSR, rated party, 185, 186. So wherever they think there's something where the stakeholders need a comfort, they are asking the auditors to comment on specifically. So currently they may have not asking for commenting on the, say, the revenue recognition, but wherever there is a sensitive topic, they are asking auditors and adding those clauses in the main audit report. So this is the overall coverage. We'll give the overview of the clauses, reporting requirement, and the key points which needs to be taken care by us while doing the audit. As you mentioned about planning, that at this point of time, the audit must have started. It must be at the closure stage. And if you go to the client कि भाई ये भी reporting चाहिए audit report के लिए ये data और भी दो, he will not be in a comfortable way कि पहले से बताना चाहिए था अभी क्यों बता रहे हो. So what we need to also learn that whatever need, whatever questions, whatever comments which we need to report has to be discussed with the client, with the team members before we do the execution or the time of the execution. So the institute has also given, as Prashant mentioned, that there is a entire audit work paper checklist which has been there and which also includes a specific checklist for CARO. So whenever an area is been done by the team member, they can look at those pointers which are there and discuss with the client on one-to-one basis. These are something which we as an auditor are responsible to comment on it. So rather than asking at a fag end of the audit, it can be on the parallelly during the execution. As I mentioned, CARO is not something new. It has evolved over the period based on the history, based on the different reportings which have come up, non-compliances which are there. And to increase the overall confidence of the stakeholders, more and more reporting has been added to this audit report. 2020 was deferred for 2 years, mainly because the clauses which were there were more onerous on the company. So Schedule 3, they have amended, and those disclosures, they were asking the company to first disclose it and then the auditor to comment on it. Earlier, it was only the auditor who was to comment. So that 2 years that was not applicable, and post that it made applicable. This is a snapshot of the applicability of CARO 2020. On the your left-hand side, unconditional exemptions which are there: banking company, insurance, small company, 1 person, and Section 8. So CARO does not apply to these categories of the entities. So small companies and Section 8 are good, that it generally comes, and we have to mention in the audit report that being a small company, the CARO is not applicable. It does not mean that we just remove the entire paragraph or the sentence. We need to mention that being a private company, a small company, this is exempted. There are conditional exemptions given to the private companies. However, the conditions which are mentioned, that it should not be a subsidiary or a holding company or public company. If it is there, then CARO will apply, even if it's a private company. There are 3 threshold limits which are being given. The paid up capital reserves, 1 crore. Loan from banks and FI is 1 crore. And the revenue for that one particular financial year in which you are doing audit, it should not exceed 10 crores. So these are the numerical objective parameters based on which the applicability criteria will be checked. And this is for each year. As compared to 2016, there is principally no change in terms of the applicability. However, CFS, the consolidated financial statements, there is a specific para being added. We'll cover it in the subsequent slide. This is the only new change which is there as far as the applicability is concerned. This is a snapshot of the all clauses which are there, 21, which has 37 sub clauses. Where if you see assets, 4 clauses, where inventory, fixed assets, loans, advances, statutory dues, 1 clause is there which we have to comment on the timely payments, as well as there are disputed items, equity and borrowing. So wherever there are large amounts in the balance sheet are already being there in our audit report. So this is the, I think, very comprehensive, and as I mentioned, it's more accountable to us. Onerous obligation is there on us to ensure that our reporting is correct. Fraud and misstatements. Consolidation, there is 1 clause. Compliance with laws and regulations. So CSR, NBFC, all those are things covered in the main report. Internal audit, whether it is adequate, not adequate, whether the reports which are being there, has been given to us, even that is being covered over here. It was there in the earlier 2016 and then removed and now again reintroduced. There are other three clauses, non-cash transaction with directors, cash losses, and resignation of statutory auditor. So we move forward from here. Property, plant and equipment and intangible assets. So this is an area where the audit team, by Prashant, this is the area where the team starts executing. They just do the test of detail and test of controls, do the sampling of the additions. But in regard to the overall reporting requirement, if you look at it, whether the component accounting has been done or not, whether the locations of those assets are being covered or not. In case of branches, what are the difficulties? What are the areas where the unit of measurement is not mentioned? If we highlight to them during the course of the interim audit or the interim review, then client will get some time to rectify those gaps and ensure that we get a complete fixed asset register, which is the requirement of the CARO. So I've seen most of the times where the component accounting breakup is not done in the FAR. So that also needs to be captured well in the this document. So the reporting which is required is maintaining proper records where it applies to both PP and intangible assets. Even investment property in those cases where they have leased out the property to the third party on rental basis, even those categories of assets are covered for this clause. Physical verification, where annually the company takes the physical verification, or there will be a phased program in which the FAs are getting verified. Now, in this case, as an auditor, we do not generally be present during the course of their verification. It happens at the different location, branches, site offices, warehouses, multiple locations. But what we need to advise our team members that whenever they go for an audit at the client place, at the factory premises, we need to do the test check of some of the assets, large assets. So if suppose an example, an hammer is purchased, a new hammer is purchased, they can always look at what is the OEM, which is it installed, not installed, what happened to the earlier hammer, is that disinstalled and is it scrapped or not. So those kind of questioning skills has to be developed by the team members so that client also see that they are not just looking at the documents or the invoices, but they actually physically assertion is also required. So we need to obtain the original documents of the physical verification, whether it is as per the phase program. And this also has to be done during the course of the interim stage. What we advise to our client as well as the team member that those steps has to be followed in advance rather than doing at the stage of March or after the March closure. So that by the time you complete February, in the month of March, you are already ready with your full complete draft CARO report, including this kind of observation, so that client will get some time to rectify it, and then we can accordingly change our audit report before the year end. Reasonable intervals, generally it is 3 years to 5 years. That is the coverage which I have seen across the different kind of industries. Some of the cases very difficult to verify, say the cable lines are installed or something which towers are there would be at the high location. So based on that nature of assets, physical verification may not be possible or may not be viable. So those things also need to be taken care when we are drafting the audit report. Material discrepancies, if there are any, we need to specify whether it has been properly, impact has been given in our accounts or not. Title deeds, yes, earlier this clause was not there. we need to mention only in the PP schedule below that some of the assets were not in the name of the company, but maybe in the name of the directors. It was generally in the case of motor car and vehicles. But now in case of the ML properties, they are asking that is it because of the some merger, demerger, some litigation is going on. So those data along with the gross value of the assets of the PP has to be mentioned in our audit report. So same disclosure is also there in Schedule 3. So we need to reconcile both what has been disclosed by the company and we need to then report in our audit report. I've seen in some companies, the auditors are giving cross references for the reasons that why the title is not in the name of the company, where the auditor gives the cross reference of that note instead of reproducing the entire note in the CARO report. Revaluation, wherever it is done, I think they are asking that if there is a movement of more than 10% of the net carrying value, it is upward or downward, then the disclosure has to be given in the report, and we need to obtain the valuation report which the company has taken. We need to verify whether the adjustment of that valuation report has been taken care in the accounts or not. Benami property proceedings and disclosures. Again, whenever this clause was introduced, there was a lot of hue and cry within the CA fraternity that as an auditor, are we also expected to know the Benami property law? We may have the fair knowledge of that law, but reporting on that, it's again an onerous responsibility casted. So like Prashant mentioned about audit trail, we need an expert. Here also, it is possible that we may need some expert on this domain there if there are such large cases. Some of the areas which needs to be taken care in this clause, as QRB and FRRB, they have observed that while drafting our audit report, we generally use or the choice of words are not in accordance with our main framework. So reporting required is reasonable interval and not regular interval. The meaning may not be same, but we have to use the same wordings as are given in the main bag. Only stating we are informed is not appropriate, like Prashant did mention about the inventory as certified by the management. Even in this case, if physical verification is done, we cannot just say we are informed that the verification is done. We need to apply our own audit procedure, satisfy our test, and then give our report. Capital WIP and ROU, innovation property also need to be covered. I've seen many audit reports where large capital WIP are there, and the aging of the capital WIP is also now available in the annual accounts. But the audit report is silent on that. They only mention about the PP or the intangible. But even this capital WIP has to be vouched, verified based on the phase program. So if those are not covered, we need to categorically ask the client why this capital WIP is not getting covered during the course of physical verification. It is possible that some of the assets are retired or not in use because of the technology, they are never going to be capitalized. So those tests, those questions can be asked in the course of the execution. Phase program, as I mentioned, generally 3 to 5 years is the program where the company does it. And if there are frequent changes, it means that they are not serious about the entire process and they're just doing for the sake of compliances. So in those cases, we need to highlight and talk to the audit committee or those side with the government that it can't be a frequent changes in the phase program. If it is 3 years, then please ensure that it has been maintained over the years. Right of use assets. So even those are getting covered. Whenever we get any property on the lease basis, that has to be ensured that there is a consequential impact also on the IFC reporting in internal financial controls, where we see that there are gaps in the fixed assets or the verification title, and those are not getting monitored by the controller or the finance controller, we need to highlight those matters and ensure that the books of accounts are getting updated and there is no corresponding reporting in the IFC report. Reporting in case of mortgage property, property in old name. So in case of title documents where they have taken the bank loan and the original documents are with the bank, then generally the client says कि confirmation last year दिया था ये same चलेगा. But no, this is an annual reporting. We need to obtain the confirmation from the bank on annual basis that they are holding the original documents on behalf of the company against the loan. Inconsistency between internal audit report and CARO reporting. So it is possible that in the internal audit report, they have covered some of the items on fixed assets. There is some observation, but during the course of the framing the audit report, we have not taken into consideration. So both has to linked and synced. If there are any such inconsistency, please highlight to the management that this observation is there, where the internal auditors highlighted in the report the physical verification was done by them on test check basis, but it was not available or the tagging was not done. Ensure that the action taken report is obtained from the respective location so that it is there in our records. Second clause about the inventory, again, large item in the balance sheet where we as an auditor do follow the procedure at the year end and we visit the client location at multiple locations where the quantities are getting verified. So here they are asking on the coverage whether the inventory has been physically verified by the management on reasonable interval and the procedure followed. So every company does not do it at year end. It follows the ABC classifications. Some of the things are done in the half year, in the second, in the interim period. So that program has to be obtained from the client in advance so that we know that entire population of the inventory is getting verified over the period. And the original documents which are being there, we need to obtain from the respective plant location so that we can verify whether the ERP quantity is now matching with the physical quantity which has been mapped. Generally happens that the instructions which are given to the at the shop floor whenever the activity is done, the plant may be running. They must have not closed it. So what are the instructions given by the management or the finance controller at the plant level that the inward-outward movement has to be stopped for that particular period of time? Only then the activity of verification has to be done. Otherwise, there will always be a mismatch between the book quantity and the physical quantity. So those questions and those steps has to be looked into by us when we get the entire physical verification report. The reporting requirement says any discrepancies of 10% more in the aggregate for each class of inventory. So RM, PM, WIP, semi-finished, in each class if it is more than 10%, and that also in terms of the value. They are not talking about the quantity. So any variation beyond 10% has to be inquired, has to be whether it is properly dealt with or not. Now, computing 10% would be a very Herculean task. It is possible that over the years, over the period, the RM are being verified in batches. We need to collate the entire verification report of the RM and then see whether that it is crossing the threshold limit of 10% or not. Only then you will be able to answer this question. Otherwise, where the inventory is more than 500, 600 crores and RM is 50% of it, giving the comment on 10% would be very difficult. So that calculation has to be obtained from the client in a year. What is the total quantum of RM which has been verified and what is the total gap between the physical and books in terms of the value? Accordingly, we can comment on our audit report. Reporting on mismatch in quarterly statement. Prashant did mention about this, that in case of the working capital loans, which are again the secured against the current assets, the company is also required to comment in their accounts and auditors are also required now to comment on it. Okay. the statements which are submitted to the banks, either it is inventory, debtors, creditors, along with their aging, if it is submitted to the bank, whether it is in sync with the books of accounts or not. On quarterly basis, we are not doing an audit. So it only comes at the year end. In case of the listed companies, we may be doing the limited review, but may not be looking at those statements or the balance sheet position. At half yearly basis, the balance sheet numbers are being given. But it is possible that the bank will require the statement by, say, 10th of the next month, and the audit must be completed by 30th. So there will be time gap between the submission to the bank and the final numbers which are freezed. So what I've seen in most of the companies, that on quarterly basis, if the statements which are submitted does not reconcile, they submit one more certificate or one more document to the bank. So this is the final number based on our audit or limited review completion, and this has to be kept on record. And as an auditor, we need to take that copy with an acknowledgement that yes, this is the final copy which was submitted. Only then we can comment that there was no difference between the books and what is submitted to the bank. Because when these points are being raised in the audit report, the management says that why these discrepancies are there. It could be due to multiple reasons. Either stock in transits are there, the provisions which have been done for the slow moving, non-moving item, the moving average, and the some rectification has to be done, some overhead has to be added. All these activities we generally do when the audit activity is done. But when the client submit to the bank, those year-end procedures are not followed. So that care has to be taken. We need to bring them that this is a requirement under the company law. And if you don't do, we have to report, we have no choice. So if we ask them, these are the steps which needs to be taken care, ask them to prepare a checkpoints. There has to be a sign off before they submit to the bank, so that the finance controller is ensuring that all these steps are being taken care before submitting. Incomplete coverage, stock in transit and job work at site are not getting covered. These are the observations which we come across during the course of the audit. Computation of 10% as we spoke, based on the value and not on volume. Appointment subject to the year end. In case of a new auditor, we may not be present during the course of the inventory verification. So at that point of time, we need to mention it in our audit report, the main audit report, as well as a cross-reference in CARO, that our appointment was post the 31st March, and hence our representative were not present during the stock take exercise. Because the same thing during the COVID period, where we were not able to visit the client premises and the plants, we did a Zoom call and some virtual call based on which the test check was done. And in some cases, it was where if we are not done on 31st March, but we did sometime later on, maybe in the month of May, at that time we do the rollback process to ensure that the quantity was correct. Accordingly, our audit report has to highlight the process which we have followed. Mismatch in statement submitted to bank, this we spoke. Loans advance, again, you must have read the last report of the NAFRA on the CCD, the Kapadia, where they have highlighted this point that if there is a diversion of funds and the auditors are not able to highlight it or not applying that audit procedure to comment on it, it would be a gross mistake. So we need to ensure that in those last transactions, whenever there is a loan, advances, investment, what are the steps taken? What are the resolution being passed by the board of directors, audit committee, whether the compliances has been done under the Companies Act or not, has to be covered. Before CARO 20, the reporting which was there was required in respect of loans given to parties covered under 189. It was a very narrow reporting under 2016, but when it came to 2020, it covers all the parties reporting is required to be made for investments made, loans, advances, guarantees provided or securities given for all the parties. So both the items are also enlarged as well as the parties are covered all. Clauses in relation to investments made, loans, advances granted, guarantees provided. So there are two scenarios which are being covered in the next slide. What are the reporting requirements under this clause? So these are the disclosure which we need to give in our audit report whenever there is a loans and advances, guarantees or securities given to subsidiaries, associates and JV. It's a single bucket. We need to specify the aggregate amounts for those categories of parties and other parties. Regarding the prejudicial, in case of interest-free loans, we need to ask questions to them that on what basis the interest is not getting recovered from the counterparty. Is there any consideration for that or not? So our reporting is not only for loans, but also for investments made. If the company is making investments, maybe in case of, say, a normal investments mutual fund, even then this clause will be relevant. If you are making investments, we need to ensure that those investments are normal investments and are not prejudicial to the interest of the company. It is not only investment to subsidiaries, JV or the associates. The CARO says any investments. These are the additional reporting for the loans and advances granted. So again, this clause, more emphasis was given because of the non-compliances, because of the diversion of fund. So the audit report was enlarged and they asked the auditors to comment on each and every aspects of the compliances, which the audit committee or the board of directors are the primary responsibility to ensure this compliance. But now we are also responsible to ensure that they have taken proper care to ensure that these are being properly complied. Evergreening of loans, whenever there is a loan given in, if it is due for renewal, it should not happen that the same loan is repaid and another loan is being given. If that is the case, now there is a specific reporting on this matter. Details and percentage to be given for fresh loans granted to repay the existing loan. If this counterparty or the subsidiary are not able to pay on due date and they are paying and we are giving back the loans, then in that cases, we have to report it. Loans regularity and overdue amounts. Again, if there is a tracker sheet which has been maintained, there is a due date as per the terms of agreement agreed upon, we need to ensure that those timelines have been met. And if it is overdue, we need to mention in our audit report. If there are loans repayable on demand, where the terms of repayments are not specified, it is an open-ended, then we need to disclose the following: aggregate amount of such loans, percentage to total loans, loan to promoters, and loan to the RPT. So this is a requirement, disclosure requirement in our audit report for wherever there is a loan on demand. These are some points to be covered in this section of loans and investments. Guarantee is not covered. During the course of drafting the audit report, we generally focus on loans and advances given and not the non-fund based. So guarantee is also required to be commented and we need to audit and we need to report it. RPT and other disclosures in financial statements not aligned with CARO. In case of the related party disclosure, if the movement has been given for loan given to subsidiaries, loan repaid to other parties, those has to align with our reporting in the audit report. It can't be a mismatch. We spoke about test of prejudicial, where the guarantee commission is not charged. It is only a guarantee given, but we are not charging anything. So we need to ask that why, what is the consideration for giving a guarantee? Under Ind AS, there will be a another accounting implication, but in IGAP, generally we saw that there is no separate consideration for it. Practical issues are there where there's a large volume in case of the NBFC, very difficult to comment on regularity. So we need to ensure that what are the controls inbuilt in the system to identify those cases. Company securities mortgage for loan taken by group companies. Identification of transaction leading to evergreening of loans. It is very difficult to, in hindsight, you may know that these are the transaction of evergreening. But when you are, as Prashant mentioned during the course of his talk, we are in a running train. At what point of time, what will trigger? At the ground level, we are not there. Our team members are there. So we need to ask them that this question has to be posed to them. This has to be seen. This has to be inquired. Only then it will surface to us. Otherwise, we may not be able to look at each and every trail of documents. $185, $186, I think in the earlier talk, we did cover on this topic. Again, they are asking auditors to specifically comment on this topic and give their comments on the compliances of these two sections, loan to directors and person connected to the directors. Again, definition under Companies Act and the Ind AS related party, both are different. So we need to have that larger definition for this purpose. If there are non-compliances, these are the reporting requirements which we need to incorporate in our audit report. Investment through one or more than 2 layers of investment. Generally, this is not the case which I have seen. Loans given or guarantee given or security provided or acquisition of securities exceeding the limits where 100% of the paid up capital and the reserves or 60%. If those limits are crossed, we need to report the name of the company, amount involved, balance, what is the closing balance, and any remarks. Loan given at a rate of interest lower than the prescribed rate, any other default. So these are the specific questions which are there in the BEAR, which we need to comment on it. There are such non-compliances. Few points on this topic. If there are running accounts with a subsidiary, with an associates, it is more of a current account. You may not know कि ये loan account है, current account है कि reimbursement है. उसने इसके behalf पर payment कर दिया, उसने उसके behalf पर receipt कर लिया. So they will say, these are all control accounts, but not a loan. So we need to know and distinguish between the two. Okay, how do you distinguish these are reimbursement transactions or these are pure loan transactions? Advance given to directors and relatives. Again, we need to ensure that the disclosure which are given in the annual report, in the RPT, are aligned with the audit report. Interest-free loans lending to non-compliances. Under the Companies that we cannot give interest-free loan unless it is a private company where there are specific exemptions being given when it is between the company and the wholly owned subsidiary. There are specific exemptions given. Guarantee letter of comforts, where we generally look at the fund-based reporting and not the non-fund-based reporting, even that is getting covered. Deposits, I think here, again, there was a non-compliances in the large companies, NBFCs. So this reporting was introduced. And the Companies Act 2013 also came up with deemed deposits, where there are multiple items under that section which will fall under this section. If there are such deemed deposits, we need to report on it. In case of advances, if it is more than 365 days, why it is not moving, will it fall under advance deemed deposit or not? Whether the company has filed DPT3, which is required to be done on a yearly basis. All those checkpoints has to be there in our area-wise checking so that at the time of reporting, we can cross-check it. Deemed deposit not covered while reporting. Declaration from directors adds, because one of the point which was there that the money or the loan which has been given by the director, we need to obtain a declaration from the director that they have not taken a loan from another party and giving back to the company. So that declaration is required under the company law. The company secretary generally takes care of that, but as an auditor, we also need to ensure that we have that declaration in our records. Share is not allotted within 60 days from the receipt of share application money. Again, this is a non-compliance which needs to be reported. Advances received for goods and services outstanding for a period of more than 65 days. There is a specific clause under that deemed deposits, and accordingly we need to report it. Again, here in case of infrastructure company, like in real estate, there is a carve out where in those cases, even if it is more than 65 days, it will not fall under that bucket. But in case of normal manufacturing and other service sector, this will be deemed deposits.
If it is deemed deposit, then we have to only report, or then all other compliances we need to report.
They need to report it to the ROC that these are the deposits, and the reason for it, that maybe because of the project is on hold or there is some extension, and hence the advances were not converted to the actual revenue, and hence it has been lying as a liability. So it is not a deposit. So they need to report it to ROC, and we need to accordingly mention in our report. So the deposit regulation per se will not apply, but reporting has to be done to the ROC.
Public deposit.
Yes,
The compliance still have to-
yes.
Public acceptance of public deposits. Yeah.
In this cases, in case of advances, the view which has been taken by the industry that if it is a normal course of the business and advances are lying and they are not able to generate revenue because of some reason, because of the project on hold, and hence, though as per the definition, it is more than 65 days, but will not fall under the public deposits. So in the remarks column, when they file with DPT3, they need disclose it to the ROC. Cost records, again, as an statutory auditor, we may not know the entire gamut of the cost audit, but in which industries the cost audit is applicable, cost records are there, applicable or not, we need to have that. So in even the CARO checklist, there are industries to whom the cost records and cost audit will be applicable. That listing has been given. Accordingly, we need to map it. We need to also check the last year cost audit report which has been there. Is there a new product which has been introduced in the current year or not? Those kind of questioning has to be done at the time of initial audits. So I've seen in these cases, if there is an normal manufacturing entity and they have a windmill or power generation or a boiler. So per se manufacturing product will not fall under the cost records, but this captive consumption of windmill or power generation through windmill will get covered. So they need to maintain the cost records for that particular segment where we need to mention. Statutory dues. So there are two parts or two limbs to this clause: disputed and undisputed items. Disputed, the amount involved in the forum where the dispute is pending. I've seen where this amounts, whenever we report in our audit report, it has to ensure that contingent liability in the notes to accounts has to sync with our reporting. Wherever it is an unpaid amount, there is a dispute going on, whether the corresponding reporting is there in our audit report or not, that has to be a proper reconciliation between the two numbers. In case of undisputed, the extent of arrears of outstanding statutory dues as on the last day of the financial year for a period of more than 6 months from the date they become payable. Here, even if the company wants to pay, in some of the cases, say PF, where due to some other non-linking, there are certain employees or workers, they are not able to pay. So they are asking if we want to comply with this regulation, but because of the technical issues, we are not able to pay. But as an auditor, you don't have any other option. If it is unpaid for more than 6 months, it has to be reported. If it is delayed, what we can do that specify in our audit report that this amount is unpaid. There is no dispute on this amount, but due to some technical difficulties or lack of linking of the Aadhaar and the Aadhaar that UID number, they are not able to pay it. That fact can be captured in our audit report and then specified. Generally, regular versus regular. In most of the cases, I've seen that there are delays in TDS or other GST items. We can see in the interest ledger account, there are certain payout towards it. So based on that judgment, we need to specify whether we need to say generally regular or we specify there is a minor delay in those statutes. So there's here we need to apply our judgment on case to case basis, what to be mentioned. Widen scope, all the statutory dues are covered. So even if there is any corporate tax which has been there, they have not paid, it is also a statute which has been there. So if that there is unpaid, there is a arrears, we need to capture it. Align with contingent liability, unpaid PF due to Aadhaar not linked, additional care to be taken like property tax. Earlier, 2016 was covering dues of income tax, sales tax, service tax, or duty of custom. Whereas in CARO, they have covered all the statutory dues. So they have enlarged the scope of reporting for statutory dues. Surrender of unrecorded income. So even as a statutory auditor, you may not have the domain expert of direct tax regime, but if there are any assessments being carried out, if there are any such case of search in the earlier talk also we spoke, in those cases we need to read the minutes of the meeting where the board has acknowledged that this is the claim by the department and they have counter appealed. We need to have the meeting with their tax consultant to understand what is the implication of this. Accordingly, we can report in our audit report. So here, the transactions which are not recorded in the books of account, something has been offered to the tax, but not included in the books of accounts, that has to be reported. Auditor is required to report whether the same has been properly recorded in the books of accounts or not. Till now, it was only the assessment order or the between the tax department and the company where any claim or anything which has been offered has been tax has been paid or not. But whether that corresponding income has been included in the books of accounts, that was never verified. Now it has to be reported whether it has been included, incorporated in the books of accounts or not. Again, it requires some domain expert on which scenario, whether the company isn't to appeal, whether it is now going to the second appeal or not. Accordingly, the decision has to be taken. All additions made in the tax assessment do not trigger reporting. So again, based on the facts, judgments, this needs to be taken care. Income tax search, additional care to be taken while reporting. Impact of such unrecorded transaction on FS. Again, there is a corresponding reporting on the IFC. On what basis? Was it related to some gaps in the system authority metrics? Is there a revenue leakage? Was the debit note, credit note resulted into that income which is getting offered? So we need to identify what was the root cause of offering that income. Based on that, we need to change our audit procedure for the current year. And certainly, if there are any implications of the fraud reporting, which needs also to be examined under 143.12. Loan taken. Now, earlier what we spoke about the loan advances given on the asset side. Now this is on the loan taken by the company. Here, the government on the regulatory bodies are asking that whenever you receive money from the public, what care has to be taken. whether the payment is on time, whether interest paid is on time, whether the security is proper or not. So those kind of questionings, they are asking the auditors to comment on it. So these are the reporting requirements which have been there. If the company is declared a willful defaulter by a bank, FI, other lender, we need to report in our audit report. If term loan is utilized for other purposes, if there is a sanction letter based on which there is a specific plan for which that term loan will be utilized for the purpose of XYZ location or the plant. But during the course of the audit, we came to know that this money has been not used for plant X, but used for plant Y. Then it has to be reported in that fashion. Whether the sanction letter has been amended or the permission or the NOC has been taken from the bank to use or change the purpose of the loan, that has to be inquired. If fund raised on short-term basis, which have been utilized for long-term purposes, say working capital loan has been taken, but they are used for the capex, then it would be a non-current item, but the liability will sit on the current liability. So in that case, we need to report this mismatch. Company cannot use short-term funds for long-term purposes. If the company has taken any funds from any entity, person in order to meet the obligation of subsidiary, joint venture and associates. Again, very difficult to identify this issue. In hindsight, you may know, but during the course of audit, if the money has come, if there is any trail where there's a back-to-back movement of the funds, where on date X you get the money from the bank and immediately on the next day that money has been given as a loan to our counterparty, there we need to ask that which money has been used for what purpose, what is the source of that fund. If the company has raised loans during the year on the pledge of securities which are held in the subsidiary, even there they are saying to give the details and report if default in repayment. So whenever there is a loan taken and there is a liability in the books of account, we need to ensure that our audit procedures are there, our checkpoints are there for the timely payments of the principal, interest, for the willful defaults. We need to ask to the client, we need to look at the public domain, what information is available so that we can have our audit documentation in place before we report. Some of the examples of diversion of funds, short-term funds used for long-term purposes, deploying borrowed funds for the purpose of activities or creation of assets other than those for which loan was sanctioned. So their purpose and the actual utilization does not match. Direct or indirect transferring borrowed funds to the subsidiaries and group entities. Routing of funds through bank other than the lender bank. So if there is a specific escrow account which needs to be maintained by the bank, but the money has been not deposited in that bank account, that money has flown to another bank account, we need to highlight this, we need to comment on this because that is the requirement of that particular sanction letter. Identification of issues, diversion and completeness in reporting. Because of the voluminous nature, it will be very difficult to do the 100% testing of the entire transaction. So based on the large amounts, we need to apply that procedure and identify whether in those cases the company is complied with or not. Only uncorrected defaults are reported. So here the requirement is to report even if it is a corrected default, even those cases has to be reported in our audit report. So not only the uncorrected plus one which have been now rectified before the year end, those also need to be covered. Existing defaults of earlier year. So though CARO is for reporting for this financial year, but if there are any outstanding default of earlier year as of March 24, even those need to be included in our report. Reporting for funds borrowed to meet obligations of JV is missed out. So what we cover is only the subsidiary, but even if it's a JV, even that reporting has to be done. Reporting on use of funds. Again, in the earlier section, we spoke about the loan or the borrowing from bank and FI. Here, they are talking about the money which you have borrowed from public through IPO and FPO or debentures which are convertible. So government is framing that whatever money we are taking or the inflow which the company is taking either through bank or through the general public, what care has to be taken so that the money has been used for the principal business of the company and not diverted. And hence this clause has been added. So in case of listed companies, there is a merchant banker who takes the care of all these compliances. But now we also need to obtain that report which has been submitted to the exchanges on quarterly basis for the utilization of the IPO money. Every quarter, listed companies are required to report on it. That needs to be obtained by us. We need to verify and report it if there is a non-compliance. So again, separate bank, if there is a preferential allotment of shares under the Companies Act, it is required to open a separate bank account where the money will flow in. It can't be in a normal current account. Separate bank account that has to be opened, there the money has to flow, and then it has to go to the capital whenever there is an allotment of shares. It can't be in a normal current account. Valuation report not obtained leading to non-compliances. That's the law. Whenever there is an fresh issue of shares at premium, they need to obtain the valuation report, which we need to also obtain it verified with our accounting entries and then report. Reporting of fraud. So all frauds are to be reported in case of fraud on the company or by the company. The fraud on the company by any person has to be reported in this clause. So the amount of fraud and the nature of fraud. So in a normal retail, if there are employees where there is a large amount of cash getting collected, getting deposited, if there are say 100 to 200 stores at a company level, I'm sure there will be some embarrassment at any point of time which may not come to us, or during our audit procedure we may not know. But during the course of the cash count, when we go at the year end or interim, we need to inquire with that store manager that what are the checks and balances being followed so that the daily cash receipts are getting deposited in the next day bank account. So those care or that audit procedure we need to capture in our records. In this case also, when the NAFRA has raised one specific point that in case of though amounts are not more than 1 crore rupees, whether we need to report to the central government or not. But in the larger view, which was being thrown that whenever the observation or the fraud has been identified by the company directly, not by the auditors, then the auditors are not required to report to the central government. Whistleblower, whether the auditor has considered whistleblower complaints, if any, received during the year by the company. So in case of listed company, yes, there is a mechanism where a separate email ID has been there and any party, either company employees or outsiders, can raise a claim that so and so are not in order or there is a bypass of the vendor money. In those cases, what procedure the audit committee or that specific whistleblower committee has been taking to ensure that it has been addressed, and if there is any implication on the accounts, there has been taken care. So those questioning has to be done whenever there are those cases during the year. Scope of reporting is very wide and not limited to officers and employees of the company, which was in the erstwhile 2016, but now it is all the parties. Lack of documentation to support that appropriate and adequate audit steps have been performed by the auditors. As an auditor, when we comment on it, we should have a checklist. Okay, these are the steps which we have as an audit team checked, documented, inquired with the management, based on which we are giving the comment in our audit report. We cannot just say कि भाई कुछ fraud नहीं हुआ, कुछ बताया नहीं, इसलिए हमने कुछ report नहीं किया. So during the course of the peer review, they will ask what steps we have followed as an auditor to ensure that any fraud during the current year is not correct. In case of NBFC compliances, auditors need to take into account the quarterly fraud reporting done by the management to RBI. So these are the tips where we can obtain the reports which they have already submitted to the respective regulatory authorities, and based on that we can give our opinion. 143.12 requires reporting of fraud by auditors identified by the auditor during the course of the audit, whereas CARO requires reporting of fraud noticed or reported during the year. So again, where there was a mismatch between what is the responsibility on the auditor, whether informed fraud, where the management inform us whether we need to report or not. Nidhi companies, I think we can skip this part. In most of the cases is not applicable to the entities. It only applies to those companies which are in the category of Nidhi. Reporting on transaction with related parties. 177, 188 again, very relevant topic where we saw a lot of diversion of funds, and compliance with 177 and 188 is being talked upon during the course of the audit committee and the board of directors. So whether the listing of the parties are there, whether all the transactions have been covered or not. So now even the audit committee or the independent directors are worried that the approval which has been taken, whether the prices are at arm's length or not. So completeness and the accuracy of the pricing is being now questioned by the independent directors to the board. So here we need to ensure that adequate reporting has been done in our financial statements. So that we need to comment on it. Generally, in audit report, we give the cross reference of related party disclosure. It is in compliance with the 177, 188. Identification of related parties, completeness of listing provided by the management. We generally take a letter of representation in terms of the number of parties involved. We rely on them to the extent of the parties to whom there are transactions. Change in the group structure. Example, ultimate parent which is incorporated overseas. So in a chain of the Indian company where the ultimate beneficiary or the holder will be outside India. So there will be parent company in India and then the ultimate parent company outside India. There is a specific disclosure under Schedule 3 where we need to report on the ultimate beneficial owner. Even there has to be a form which has to be filed with the ROC. We need to obtain that record as well in our audit file. So generally lack of documentation and subjectivity as regard arm's length. That on what basis the price which has been agreed upon between a subsidiary and a parent company is at arm's length. We need to take the basis or the RPT policy which the company has framed, that do they do benchmarking with the similar product supplied by another counterparty. This would be a challenge in pharma companies where it is a unique product or approval which has been obtained from US FDA, and you will not get an alternative vendor of that particular material or the part. So in those cases, we need to ensure that what is the margin being maintained by both the entities at the product level. Reporting on internal audit system. So as an internal auditor, if this scope has been devised at the beginning of the year, we need to ask what are the areas getting covered in a particular financial year, whether any changes are required or not. If there are any specific areas, say statutory compliances are not getting covered by the internal auditor, we can ask them, please incorporate in your schedule. If IFC testing is not getting covered, we can ask them. So apart from it, what we can also do is on quarterly basis or half-yearly basis, there has to be a dialogue, there has to be some discussion between the statutory auditor and internal auditor, so that if they can share the synopsis or the highlights of their observations, if there are any control gaps, if there are any manual intervention in the system, or if there is anything which they want to share with the auditors. So that discussion at the earlier stage will help, so that if there is any corrective measures can be taken before the March end. So the reporting requirement says whether the company has internal audit system commensurate with the size and the nature of its business. So if, as Prashant did mention, if there is only one area being covered by them, it will not be commensurate with the size of the company. So it should cover the larger areas of procure to pay and the cash to bill and everything on the top line, purchases, inventory controls. Nowadays, even the compliance with the vendor masters or the customers masters are getting covered. Okay, what are the internal controls in place to ensure that the KYCs of these two vendors as well as customers are correctly plotted in the system, in the ERP? Whether the reports of the internal auditors for the period under audit were considered by the statutory auditor. Many times, if tomorrow is a board meeting, we get the report today. So that is a time gap between the two. So this needs to be highlighted to the management that we need the report in advance so that we can understand the implication, if any, on the financial statements. So this is the way in which they are saying whatever reports has been issued till the board meeting has to be received by us, and if there are any implication on it in the accounts, it has to be taken care of. Non-cash transaction with directors, again, they want to avoid this kind of transactions with the directors. Generally, I have not seen this matter to be reported anywhere. But what, as an auditor, we need to check, are there such transactions in the current year? What is the past history? What is the culture of the company? If there are any cases of sale to the director, but the money has not received, is still outstanding, we need to inquire it. So those kind of procedure has to be inbuilt in our audit steps. So they are asking us to comply with section 192, whether the company has been complying with 192 or not. NBFC activities and RBI regulation. So as an auditor, we are supposed to understand even the NBFC law, the RBI law, where if there are any CIC, the core investment companies, whether the company is registered, unregistered, whether the at group level there are more than one CIC or not. So here we need to connect with the group company secretary so that they can give us the confirmation, because we may not have the access to their information. So we need to have that audit step within us, that we raise the request to the group auditor or the group company secretary, and they inform us and we comment based on it. Cash losses. Whenever there are losses in the company, we need to report what is the cash loss for the current year and the preceding financial year. So cash loss is not defined under the Act, but we need to go based on the general parameters which have been given. So whatever is there in the P&L account plus the non-cash item, depreciation, amortization, and if there are any qualifications in our audit report, that has to be quantified, that has to be adjusted, and then the cash cost has to be given. So if you are not able to quantify the qualification, accordingly, this clause also needs to be qualified or needs to be taken care, that because of this limitation, this amount is not getting quantified, and hence our cash cost figure which is reported is subject to so and so qualification. Resignation of statutory auditor. Whenever there is a resignation of an auditor, we need to have one joint meeting with the earlier auditor, though we take an NOC from them. But if there are any such concerns being raised by the erstwhile auditor, whether we have taken those into consideration for the audit of the current year, that has to be reported now. Again, here also, as an audit procedure, as an audit work paper, we need to have one document wherein we are saying that we did a communication with the auditor and their concerns were understood from them. These were the cases which they have highlighted. Maybe they have highlighted on the internal control on discounts which are given to the customer, where they are saying there is a lot of management estimates involved and hence it is a part of CAM. So this is concern which they have highlighted or high risk item in the audit of the financial statements. So that is something which we absorb and accordingly we change our audit procedure based on it. Opinion on liquidity. Here again, government says if there are, though you are following auditing standards on going concern, but still you comment specifically whether the company as of 31st March year end, based on the liquidity ratios, based on the current assets, current liabilities, are they able to sustain for the next 12 months or not? So here on the data of audit report, SA 560, subsequent events, what are the budgets? Are there any cases where we estimate कि भाई ये plant बंद होने वाला है या ये product बंद होने वाला है, but still as a company to still be going concern, we need to specifically report on this particular matter. We need to verify the financial ratios, aging, and expected dates. If there are any continuous defaults by the company, if there are willful defaulters, then this could be one of the indicators to comment on this. CSR, again, there are two ongoing projects and other projects. Again, ongoing projects is not something which is defined under the Act. We need to apply our own judgment and whatever the company says that this is an ongoing project and hence we will deposit in a separate bank account and we will use it over the period of this. So one of the cases I heard that if the company has given a commitment for, say, the students who are in the primary and secondary school and up to 10th standard, they will fund it, their entire education. Will this be categorized under the ongoing project? So again, there are two views possible because there is a start date, you enroll the students and there is an end date of 10th standard. But the funding is for 3 years or the timeline is for only 3 years. They will say every year at the inception of the academic year, they will fund the entire corpus to the schools or the colleges. Accordingly, this will be treated as an ongoing project. So different views are there. There are listed companies who are taking the view that this is also an ongoing project and these funds can be parked in a separate bank account. Yeah. So we need to ensure that the section 135 of the Companies Act is taken care whenever there is unspent amount, whether it is paid to the earmarked accounts or it is deposited in the PM Care Fund. As Prashant mentioned that generally at the fag end of the March, the company is aware कि भाई इसका तो payment करना बाकी रह गया है, इसको payment करो. And 31st March, we see there are entries in the BRS. 31st March के अंदर BRS में खड़ा है वो transaction. We need to inquire with them that how the money has been utilized by that trust, by that NGO, if it is paid on 31st March and still under the BRS, because the CSR committee also need to take the utilization certificate from that NGO. So we need to inquire that part as well. CFS, if there is only standalone accounts and company does not have any subsidiary JV, then this clause will not apply. But in those other cases where there is a subsidiary JV association and a company prepare the CFS, even if they are not the auditor of those component entities, as a statutory of the main entity, we need to incorporate all the qualifications which are there in the subsidiary or JV or the associates. If the audits of those entities are not completed by that time and they have been taken as a management certified accounts, we need to also specify that so and so entity's audit is not complete and then we have taken based on the management certified accounts. But here it's very difficult for stakeholders to understand from the clause number, because what the reporting requirement says, name of the company, paragraph number of the CARO reports. But exactly what is the qualification? We'll have to go back to the annual report of the company and look at the subsidiary accounts, which is required to be published on the website. There we can cross-reference what is the content in that report. Some practical tips to the, I think it is more for our team members, where seniors can guide to the articles as well as the qualified team, that do not copy paste. We need to prepare as if it is the first year, and clause by clause we need to comment on it. Checklist to be filled during execution, not at the end of the audit. Cover key aspects during the planning stage, which is the crux of the entire audit. Without planning, we are definitely going to fail. Cross-reference CARO points with disclosed in the annual report. Wherever there is a CSR or any 188, 196, those cross-referencing has to be ensured before you sign off. If there are any qualification adverse remark, we need to ensure that the IRC report is also being taken care or not. Modification of audit procedures. Wherever we see that this area, the comments are not proper or the documents are not proper, we need to alter our audit procedure so that we properly take care for the reporting part. Some of the reference material for your team. These are from the institute only. Wish you all a successful and productive audit season. Thank you very much.
Anyone who has any questions? We can pass the mic to you. Okay, so I think your presentation has been quite comprehensive. People are, or maybe they are in shock. कितना काम करना है.
One point which is there also, which is motivate. We need to motivate our team members to ensure that this is our audit is compliant with whatever is needed under the law. Because we listen to it, but in the course of execution, we fail to follow it. So it has to be on continuous basis and improve. I also one of their part where if it is not done now, but when.
Thank you, Bhavin, for noticing our SMIL. Okay, now to propose a formal vote of thanks, I request CA Jayesh.
Thank you, Kanai Madam. Before we move towards the proposing our hearty vote of thanks, I would like to raise one question here. The members, since morning we are on the auditing only. I observe personally the auditing in nowadays it is not that easy, right? Especially after listening both the speaker, I think you must also agree with me. Okay, now my second question is, have you found this both the speakers and the deliberation? Have you find it? It was in detail, right? Right. So why we decided to keep these sessions at early of this month? Because we considering the importance of the audit season and considering the issues faced by the auditor, right? And especially their team members. So we decided to have these sessions, and luckily we had both the good speakers today on the same day. Thank you, Bhavin Bhai, for your detailed deliberation on CARO, right? I must say CARO is introduced since long back, but even today we are not in that situation that we comfortably we can report everything. So with this painful efforts, Bhavin Bhai, thank you very much for giving us your valuable time with on behalf of our JP Nagar CP Circle. We propose a hearty vote of thanks. Thank you.
As usual, please share the recording of the session as well as the PPT also.